Before your first interview, before your first home, before anyone asks who you are or what you've survived, America asks one question: what is your credit score? 3 digits. That's all it takes to open doors, or quietly lock them forever. You can work 2 jobs, you can pay rent on time for years, you can sacrifice, save, struggle, and still be told, sorry, you don't qualify. No explanation, no second chance, just a number that speaks louder than your story. In this country, freedom is advertised as universal, but access is conditional. And for millions of Americans, that condition is invisible until it destroys them. How trust was turned into a formula. There was a time when trust was personal. Banks knew your name. Lenders knew your family. Your word, your reputation, your history, they mattered. But humans are slow, and profits demand speed. In the mid-20th century, a simple idea was born. What if trust could be calculated? What if risk could be reduced to math? So people were turned into profiles, lives into data points, and trust into a score. It was efficient, it was scalable, and it was never designed to forgive. When a tool became a judge, at first, credit scores were only for banks. Then landlords wanted them. Employers asked for them. Insurance companies priced people by them. Quietly, without debate, a financial tool became a social filter. A low score no longer meant you might default. It meant you are unreliable. The score stopped predicting risk and started defining worth. One mistake that follows you for 7 years, lose your job for 3 months, miss one payment, face a medical emergency you didn't choose. That moment doesn't pass, it stays, it follows, it waits. One late payment can erase years of discipline. And even when you recover, the system remembers your worst day longer than your best decade. 7 years. For many, that's not accountability, it's a sentence. Survival debt in a country that calls it choice. America holds over $1 trillion in credit card debt. This is not luxury spending. This is groceries. This is rent. This is medicine. This is survival. When wages fail to keep up with reality, credit becomes oxygen. But oxygen here comes with interest. 20%, 25%, sometimes more. And the people who need help the most pay the highest price for it. The mathematics of falling behind debt doesn't just sit there. It grows while you sleep. It compounds while you struggle. It multiplies while you try to breathe. Minimum payments barely touch the balance. Fees stack. Interest feeds on interest. Miss once, and penalties activate. Miss twice, and the escape route disappears. This is not a trap by accident. It is a business model. When life happens and the algorithm doesn't care, the credit system does not ask why. It doesn't care about cancer. It doesn't care about layoffs. It doesn't care about inflation or caregiving or disasters. The algorithm sees only behavior, not context. And behavior under pressure always looks like failure. Ever been punished for getting sick? For millions of Americans, a medical emergency doesn't just threaten their health, it destroys their financial future. You survive an illness only to find a surprise bill you never knew existed has tanked your credit score. Suddenly, getting an apartment, a car, or even a job becomes a massive struggle. In almost any other developed country, this would be unthinkable. But here, getting sick can financially haunt you for years. The world of work has changed, but the credit system hasn't caught up. Think about it. Freelancers, gig workers, contractors. Our income isn't a steady, predictable line. It comes in waves. But credit scoring models were built for the 9-to-5 era. 1 month, you need to use more of your credit limit to get by, and your score plummets. You pay it all back when a big project pays out, but the damage is already done. Today's flexible, modern workforce is being punished by an outdated, rigid system. And let us talk about the part nobody wants to admit. Bad credit isn't a bug in the system, it's a feature. It's fuel for a massive subprime economy. For lenders, higher risk means higher profit. That translates to sky-high interest rates, endless fees, and debt cycles that are designed to be almost impossible to escape. Entire industries are built on the idea that borrowers will stay trapped, paying far more over time. Bad credit isn't a sign of failure. It's a business model. This creates what many call a poverty tax. When your credit is low, everything costs more. You'll pay a higher security deposit for rent. Your car insurance premiums will be jacked up. Getting a loan for a car becomes a crushing financial burden. It's a vicious cycle. The less financial stability you have, the more you pay for the exact same necessities that others take for granted. You see ads for credit repair all the time, promising a clean slate. And while they can help with legitimate errors, the hard truth is that most negative marks are accurate and they stay. The credit repair industry thrives not because it can fix the system, but because the system creates so much desperation in the first place. So, it makes you wonder, what if a credit score doesn't actually measure how responsible you are with money? What if it's really a measure of your resilience in a system designed to profit from your instability? What if millions of people aren't bad with money, but are simply trapped? And what does it say about our society when we let a single number dictate who gets a chance to build a life? The hidden history behind American credit scores. Credit scores did not emerge in a neutral vacuum. They were built on top of older systems that already decided who was safe and who was risky. In the early 20th century, lenders openly labeled neighborhoods and people. Maps were drawn. Red lines were marked. Entire communities were declared unworthy of investment, not because of individual behavior, but because of race, immigration status, and class. When credit scoring became computerized, it inherited this history. The language changed. The math became complex, but the outcomes often stayed the same. What once said undesirable neighborhood now quietly says high-risk borrower. The system no longer needs to mention race. The data does the work. Redlining didn't end. It evolved. Redlining is often described as a past injustice, but its consequences live in modern credit files. If your parents couldn't get mortgages, they couldn't build equity. If they couldn't build equity, they couldn't pass wealth. If they couldn't pass wealth, you start life with thinner margins. Thin margins mean more credit use. More credit use means higher utilization. Higher utilization means lower scores. The system reads this as personal failure, but it is inherited vulnerability. Credit scores and where you're allowed to live. Housing is one of the first places credit becomes destiny. Landlords don't just check income anymore. They check character through your score. A single collection can disqualify you from entire zip codes, not because you can't pay rent today, but because your past suggests discomfort. So people move where they are allowed, not where they choose. Neighborhoods sort themselves quietly. Opportunity clusters away from those marked as risky. This isn't segregation by law. It's segregation by algorithm. Employment checks, judged before you're hired. Many Americans don't realize their credit can affect their job prospects. Employers claim it shows responsibility, but financial stress often comes from instability, not irresponsibility. A layoff lowers credit. Lower credit blocks employment. Blocked employment prevents recovery. This loop isn't accidental, it's systemic. You are judged before you're allowed to explain. Bankruptcy, relief that still punishes bankruptcy, is supposed to be a reset. It exists because lawmakers recognized that debt can become unbearable. But in practice, bankruptcy is treated as moral failure. A bankruptcy stays on your report for up to 10 years. 10 years of restricted access. 10 years of higher costs. You are forgiven, but never forgotten. And for many, bankruptcy doesn't erase shame. It magnifies it. The myth of the second chance. America loves the idea of redemption, but credit systems do not. They track behavior, not growth. They reward consistency, not recovery. Someone who has never struggled scores higher than someone who struggled and rebuilt. Failure leaves a longer shadow than success casts light. Why younger generations start already behind student loans. Don't just delay adulthood, they shape credit from the beginning. Graduates enter the workforce already leveraged. Debt-to-income ratios spike before first paychecks. Miss one payment early and the record begins damaged. The system treats youth as risk instead of potential. Interest rates as invisible punishment to people walk into the same bank, same income, same loan. One pays double the interest, not because of today, but because of yesterday. Higher interest compounds inequality. It turns past hardship into future hardship. This is how financial pain becomes permanent. Credit cards as emergency lifelines for millions. Credit cards are not about consumption. They are about continuity. Keeping the lights on, fixing the car, buying food until payday. But emergency borrowing is punished. High utilization drops scores. Dropped scores raise interest. Raised interest deepens dependence. Help comes at a cost that ensures you'll need more help later. The psychological weight of permanent evaluation, living under credit surveillance, changes behavior. People delay medical care. They avoid taking risks. They stay in unsafe jobs. Not because they lack courage, but because they can't afford one mistake. Financial stress becomes identity. When repair feels like confession, credit repair requires documentation, disputes, explanations. You must relive hardship in paperwork, prove that pain was valid. And even then, many entries stay. The system does not assume good faith. It demands proof of worthiness. Who really benefits from broken credit? Every late fee is revenue. Every penalty is profit. Every extended payoff is income. Bad credit fuels entire industries, from subprime lending to collection agencies. Broken credit isn't a failure of capitalism, it's a feature. The quiet normalization of financial shame debt has become personal disgrace instead of public policy failure. People blame themselves for outcomes shaped by wages, healthcare, housing, and inflation. Shame keeps the system safe from scrutiny. As long as people think they failed individually, they won't question the structure collectively. The question beneath the numbers: if millions are failing the same test, is the test fair? If survival decisions destroy scores, is the system measuring risk or resilience? And if credit decides access to modern life, who decided who deserves access in the first place? The credit repair industry, Hope for sale credit repair sounds like rescue. The language is comforting: fix, restore, clean, erase. But most of the industry does not repair credit. It monetizes desperation. Millions of Americans pay monthly fees to companies that send dispute letters anyone could legally send for free. The promise is not transformation, it is delay. Time bought with hope. And hope, when monetized, is one of the most profitable products in America. What credit repair can actually do by law. Credit repair companies cannot remove accurate information. They cannot erase real late payments. They cannot delete legitimate collections. What they can do is challenge data accuracy. If a creditor fails to respond within a specific time frame, an item may be temporarily removed. Sometimes it returns. Sometimes it doesn't. This is not fixing behavior or rebuilding trust. It is exploiting administrative weakness. The system allows this loophole. The industry thrives on it. Why errors are so common? Credit reports are not handcrafted documents. They are massive databases updated by automated feeds. In 2024, consumer advocacy groups reported that a significant share of credit reports still contain errors, incorrect balances, outdated collections, duplicated accounts, or debts that belong to someone else with a similar name. Mistakes are not rare, they are routine. Yet correcting them is treated as a privilege, not a right. The burden of proof is on the consumer. If a creditor makes an error, they are rarely penalized. If you fail to catch it, you pay for it. You must dispute, you must document, you must follow up. The system assumes the data is right and the human is wrong. This imbalance keeps pressure on individuals while institutions remain insulated. Collection agencies profiting from the past. Debt collection is a secondary market. Original lenders sell unpaid debts for pennies on the dollar. Collectors buy them in bulk, often with incomplete records. They pursue payment aggressively, knowing that fear works even when accuracy doesn't. Many consumers pay debts they can't legally owe because proving innocence feels harder than paying to make the calls stop. This is not recovery, it is extraction. Zombie debt and the endless chase. Some debts should be dead. They are past the statute of limitations. They are legally unenforceable, but collectors still chase them. A single acknowledgement can revive old obligations. One payment can reset the clock. People unknowingly resurrect debt because no one taught them the rules. Ignorance becomes liability. AI scoring and the new black box. Credit scoring has entered a new phase. Artificial intelligence now analyzes thousands of variables beyond traditional factors: spending patterns, timing, behavioral signals. The promise is accuracy. The reality is opacity. Consumers cannot see how decisions are made. They cannot challenge logic. They cannot access. The algorithm doesn't explain, it decides. And when it's wrong, there is no human to appeal to. Predictive risk versus human reality. AI does not understand context. A medical emergency looks like irresponsibility. A caregiving gap looks like instability. A layoff looks like unreliability. The system predicts default without understanding survival. Efficiency replaces empathy. They tell you to learn finance, to budget better, to be more disciplined, as if knowing how to make a spreadsheet is the secret to overcoming a system that's fundamentally imbalanced. But let's be real. No amount of budgeting is going to magically raise your wages. Financial literacy classes aren't going to lower your rent, and your personal discipline won't stop healthcare costs from skyrocketing. Yes, education is helpful, but it's not a shield. It doesn't protect you from a system that's built on penalties and fees. We're told to be responsible, but we're playing in a game that's designed to extract as much as possible from us. It's a tough pill to swallow, but knowledge alone doesn't change the rules of the game. Now let's talk about credit scores. We're taught to see them as a reflection of our character, our responsibility. But what do they really measure? They measure obedience, predictability. They reward you for paying on time, using just the right amount of credit, and never ever stumbling. A credit score doesn't know if you're a good person. It just knows if you're a compliant one. It's a system that favors those who can live safely within its narrow lines. But for anyone forced to improvise, to take a risk, or to face an unexpected crisis, it's a quick slide to the bottom. So you work hard to fix your credit. You pay down debt. You make every payment on time, and that score starts to climb. You feel a sense of accomplishment, right? But here's the trap. A higher score doesn't change the fundamental problems. It doesn't stop wages from stagnating. It doesn't create more affordable housing. It doesn't touch the high interest structures that got you into trouble in the first place. People rebuild their credit only to fall back into the same cycle, not because they failed, but because the environment around them never changed. Fixing your credit is like treating the symptoms of an illness while completely ignoring the disease itself. And what's the emotional toll of all this? Living under the constant pressure of being evaluated. It creates a culture of fear. People put their dreams on hold. They're afraid to start that business, to take that creative risk, to make a change. They choose to stay small just to stay safe. So you see, the credit system doesn't just control our money. It controls our ambitions. It shrinks our imagination. We have to remember who this system was built for. It wasn't designed to empower borrowers. It was designed to protect lenders. It's a risk management tool for big institutions and a behavior control mechanism for the rest of us. When a system is built to serve power, it rarely serves the vulnerable without a heavy price. This leads to some uncomfortable questions we need to ask out loud. If a system relies on constant punishment and penalties to keep itself going, is it really stable? If millions of people are stuck in a permanent loop of repairing and rebuilding, instead of actually advancing and growing, is that system fair? And if a single number has the power to decide who gets to live a normal life, who gets a home, a car, or a chance? Ever feel like you're doing everything right, but your credit score just won't budge? You pay your bills on time, you've cut your spending, you even stopped using your credit cards, but that 3-digit number, it's stuck. Here's the frustrating truth. Your credit score is untaid about how good you are with money right now. It's a memory system. And it has a very, very long memory for your worst financial moments. A single late payment can stay on your report for 7 years. A collection account can linger even after you've paid it off, and a bankruptcy that can follow you for a full decade. The system isn't built to reward your recovery. It's built to remember risk. And let's be honest, today's economy makes it incredibly hard to recover. Rent is skyrocketing, healthcare costs are a lottery, and just one unexpected car repair can wipe out years of careful saving. It's not that people aren't trying to fix their credit, it's that the cost of just surviving keeps creating new financial hurdles. Then there's the reality of modern work, the gig economy. Contract jobs and irregular paychecks don't fit into the neat, tidy box that credit scoring models expect. These systems were designed for a world of stable, monthly salaries. They haven't caught up to how millions of people actually earn a living today. So, even if your annual income is solid, that variability can work against you. The problem is even deeper than that. Your credit score can be shaped by where you live and the color of your skin. Neighborhoods that were historically denied fair lending decades ago still have lower average credit scores today. This isn't an accident. It's a legacy of inequality. A lower score means higher interest rates on everything from car loans to mortgages, making it that much harder to build wealth and escape the cycle. Credit doesn't just reflect inequality, it actively makes it worse. And this credit trap affects everyone, young and old. Young people start their careers buried in student loan debt, with thin credit files that automatically label them as high risk. But older Americans aren't safe either. A medical emergency after age 50, or trying to manage rising costs on a fixed income, can shatter a lifetime of good financial habits. The system doesn't care about your experience or your effort. It only sees data points. It's a flawed system, and understanding how it works is the first step toward navigating it. Thanks for watching. Let's talk about something that quietly destroys lives: medical debt. It's one of the biggest reasons people have damaged credit. Think about it too. Don't choose to get sick. You can't negotiate prices during an emergency. Yet unpaid medical bills can end up in collections, tanking your credit score and making everything else more expensive. Even with recent reforms that help with smaller debts, a single large medical bill can still be financially devastating. Your health becomes a liability, and healing comes with a credit penalty. This isn't some law of nature. It's a result of policy choices. The way credit systems are set up, interest rates, how long things stay on your report, the rules for disputes, it's all designed. When the system prioritizes lenders over consumers, a bad credit score becomes a long-term sentence, not a temporary setback. It's a system that often chooses caution over compassion. And what about bankruptcy? It's supposed to be a legal reset, a way out, but culturally, it's treated like a personal failure. People are so ashamed that they wait too long to file, draining their savings and damaging their credit even more before finally seeking relief. The stigma just prolongs the suffering. This has a huge psychological toll. A bad credit score can reshape your identity. You start to feel irresponsible and like a failure, even when what happened was completely out of your control. Shame and fear take over, making it even harder to take action. A system that's supposed to just assess risk ends up dictating your self-worth. Escaping this trap feels impossible. To improve your credit, you need credit. But to get credit, you need a good score. It's a vicious cycle. Sure, there are things like secured cards, but they require cash upfront. Credit builder loans have fees. Becoming an authorized user depends on finding someone who trusts you. Progress often requires a level of privilege that many people just don't have. So, instead of pursuing their dreams, people get stuck pursuing score points. They put off going back to school. They don't start that business. They stay in jobs they hate. Your credit score becomes a leash, and your freedom feels conditional. This isn't just about individual struggle. When millions of people are stuck in repair mode instead of building their futures, our whole economy loses out on innovation, risk-taking, and social mobility. It all leads to a bigger question. If credit determines our access to housing, jobs, and basic dignity, who should really be in control of it? And if the system is designed to keep people trapped long after their debts are settled, what does forgiveness even mean? Ever been told you can just fix your credit? After years wrestling with this system, many of us learn a tough lesson. Most of what's sold as credit repair is just smoke and mirrors. Those quick score hacks, they vanish in a month. Those paid services, they often just do what you can legally do yourself for free. So, what actually works? It's not flashy, it's slow, it's quiet, and honestly, it's draining. It's consistency, time, and protecting yourself from new financial hits. Credit doesn't reward how smart you are. It rewards your endurance. Forget the idea of a magic fix. There's no switch that suddenly makes lenders trust you again. Even when you do everything right, like getting an error removed or paying off a balance the score barely nudges. Think about it. You miss one payment and your score tanks immediately. But you pay perfectly for a whole year. You get a tiny little bump. The system is designed to punish quickly and reward slowly. One of the biggest traps is credit utilization. You can pay every single bill on time, but if your balances are high compared to your credit limits, your score will drop. This is especially unfair to people without savings. If an emergency pops up, those with cash can pay for it outright. Those without cash have to use a credit card. Their utilization shoots up and their score gets penalized. It's a system that measures how much cash you have on hand, not how responsible you are. And here's something that surprises a lot of people. Paying off a collection account doesn't make it disappear. It just changes the status to paid. That collection still stays on your report for years, signaling a past mistake to any future lender. The system values your history more than your efforts to make things right. For millions, doing the right thing doesn't open new doors. It just stops the bleeding. You've probably heard about secured cards or credit builder loans. They're often recommended as a way to rebuild, but there's a catch. To get one, you need to give them your own money as a deposit to prove you're trustworthy. You're basically paying fees to borrow your own cash, and they give you such a small credit limit that it's almost impossible to keep your utilization low. They're supposed to be ladders, but they're very narrow, and not everyone can even start the climb. Another popular tip is becoming an authorized user on someone else's credit card. This can give you a quick score boost, but it relies on having someone in your life with amazing credit who is willing to help you. It highlights how credit improvement isn't just about your personal actions, it's also about your social network. For some, the only real escape hatch is bankruptcy. It stops the calls, clears overwhelming debt, and gives you back your cash flow. And ironically, many people who file for bankruptcy see their credit scores go up within a year. Why? Because all that debt is suddenly gone. The system punishes the label of bankruptcy for years, even if the financial logic behind it makes perfect sense. But even after your score improves, you often remain a credit survivor. You face higher interest rates, lower limits, and extra scrutiny. The economy doesn't forget. This leads some people to give up on credit entirely and live a cash-only life. That can work if you have a stable, high income and never face an emergency. But in our world, almost everything, renting an apartment, buying a car, even getting a job, can depend on your credit score. Opting out is a privilege most can't afford. New fintech companies claim to have a better way using things like your rent payments or utility bills to build a more complete picture. But this isn't really progress. It's just more surveillance. It doesn't reduce judgment. It just creates more ways for you to be judged, more ways to fail. So what's the real answer? It might lie in bigger policy changes, like shorter reporting timelines for negative items or protections for medical debt. Some countries treat credit as public infrastructure meant for inclusion. In America, we treat it as a test of your character. This brings us to the core question. Should one mistake define your financial opportunities for a decade? Should the debt you took on just to survive follow you around longer than some criminal records? These aren't just financial questions. They're ethical ones about fairness and second chances. Thanks for watching. Have you ever wondered what happens to a society that never forgets? In a world where every mistake is recorded and tracked, forgiveness becomes a rare commodity. And when forgiveness is absent, something dangerous happens. People stop trying. They put off buying a house, starting a family, or launching that business they've always dreamed of. They start to avoid risks, shrink their ambitions, and play it safe. It feels like the very idea of a second chance, once a cornerstone of our culture, is being quietly erased by algorithms and data points. Think about our credit system. What does it really measure? It doesn't measure your creativity, your resilience, or your potential for growth. It doesn't care how hard you've worked to overcome a setback. A credit score primarily measures one thing: compliance. It tracks how well you follow the rules. And let's be honest, following the rules is a lot easier when you're already in a comfortable financial position. It's easier for those who don't have to choose between paying a medical bill and making a credit card payment on time. So, where does this leave us? We have millions of people who aren't financially reckless. They're just exhausted. They didn't make wild gambles with their money. They adapted to a system that often requires borrowing just to get by. They didn't fail to plan for the future. They were living in an economy where wages haven't kept pace with the rising costs of housing, education, and healthcare. For so many, a low credit score isn't a sign of a personal flaw. It's a predictable, almost inevitable outcome of the economic reality they face every single day. This brings us to a fundamental question. If using credit has become almost unavoidable for survival, if escaping the cycle of debt requires money, time, and stability that many don't have, and if the punishment for a financial mistake lasts for years, sometimes even a decade, then maybe the problem isn't just about credit repair. Maybe the real issue we need to confront is much deeper. It's about whether we, as a society, are willing to completely redesign our definition of trust and who is worthy of a second chance. The final reckoning: can America fix credit, or is credit the point? By now, the pattern is clear. Bad credit in America is not a glitch. It's not a misunderstanding. It's not the result of people failing to learn the rules. It is the result of a system designed to remember pain longer than progress. Credit does not simply measure risk, it manufactures it. The quiet transfer of power. Over the last 50 years, power shifted from wages to credit, from stability to scores, from public safety nets to private algorithms. As real incomes stagnated and costs rose, credit stepped in not as support, but as substitution. When healthcare became unaffordable, credit filled the gap. When housing outpaced wages, credit filled the gap. When education exploded in cost, credit filled the gap, and then punished people for needing it. Credit, as social sorting credit, doesn't just decide interest rates. It decides who rents the better apartment, who gets the safer car, who pays less for insurance, who passes a background check, who starts a business, who survives a crisis. Credit sorts people quietly, efficiently, relentlessly. Two Americans with the same income live completely different lives based on a three-digit number that is not finance, that is social architecture. Why reform is so hard? Everyone agrees the system is broken. No one agrees on how to fix it. Lenders profit from complexity. Bureaus profit from data volume. Politicians fear disrupting market confidence. And consumers are fragmented, fighting individual battles instead of a structural one. The system survives because responsibility is individualized. If you fail, it's your fault. If millions fail, it's coincidence. What a fair credit system would look like. A humane system would start with one principle: mistakes should decay faster than discipline. That means shorter reporting timeline, caps on interest rates, automatic removal of paid collections, no credit punishment for medical emergencies, no score penalties for survival borrowing, public oversight of scoring models in other countries. These are normal. In America, they're radical. The medical debt test. Nothing exposes the cruelty of the system more than medical debt. People don't choose illness. They don't negotiate prices. They don't shop in emergencies. Yet medical debt destroys credit like any other. When sickness becomes financial exile, the system has failed morally, not mathematically. The illusion of personal responsibility. America loves the idea that discipline solves everything. But discipline cannot outturn inflation. Discipline cannot negotiate hospital bills. Discipline cannot prevent layoffs. Discipline cannot reverse recessions. Credit pretends everyone operates on equal ground. They don't. Why education alone won't save anyone? Financial literacy helps, but it doesn't neutralize power. You can understand every rule and still lose if income is unstable. You can follow every strategy and still fall behind when costs spike. Teaching people to swim in rising water does not stop the flood. The emotional cost no one measures. Living with bad credit doesn't just limit purchases. It reshapes identity. People feel ashamed. They feel irresponsible. They feel invisible. They delay marriage. They postpone children. They avoid doctors. They stop dreaming. Credit silently shrinks the future. A generation growing up pre-labeled young Americans now enter adulthood already scored. Student loans before careers. Medical bills before savings. Credit cards before stability. They don't build credit. They inherit it. And many inherit damage. Why opting out isn't liberation. Some reject credit entirely. They go cash-only. They avoid debt. They simplify life. But this isn't freedom, it's retreat, because the system still judges them from the outside. No score doesn't mean no judgment. It often means worse assumptions. The real question America avoids, the question isn't, how do people fix bad credit? The real question is, why does survival require credit at all? Why is dignity financed? Why is healthcare billed? Why is housing leveraged? Why is education stigmatized? Credit didn't create these problems, but it profits from them. What happens if nothing changes? If the system remains untouched, more Americans will live permanently subprime, more families will delay milestones, more workers will accept worse jobs, more stress will become normalized, more inequality will harden, not through collapse, but through quiet acceptance. What change would actually require? Real change would require Americans to stop blaming themselves and start questioning the structure. It would require collective pressure, political courage, transparent scoring, public alternatives, forgiveness baked into design, not charity, not hacks, not optimism, structure. Credit is a mirror but of what? Credit claims to reflect trustworthiness, but what it really reflects is exposure. Exposure to illness, exposure to instability, exposure to an economy that shifted risk downward. Bad credit isn't a sign of failure, it's evidence. The final truth: most Americans with bad credit did not live recklessly. They lived honestly in a dishonest system. They paid when they could. They borrowed when they had to. They survived and were punished for it. The ending America must confront if trust can be destroyed in a month and rebuilt only in a decade. If one emergency outweighs years of discipline, if recovery requires money, time, and stability, then credit is no longer a tool, it's a gate. And the question isn't who deserves to pass. The question is who built it and why.